So we're going to kind of do a quick, very quick, going through 8 different strategies to consider. I'll be talking very high level about these. We're not going to have enough time to go into a whole lot of detail, but if any of these kind of are interest to you, reach out to your financial advisor and or to your attorney and just figure out if they make sense to you, and then you can get a little bit more in depth about how they would work, particularly for your own situation. So the first thing you want to do, if we can move ahead here, there you go, thank you, is to just make gifts. So the more money you give away in your life, obviously the lower your estate is going to be at death. So the first thing to do that anybody who has a high net worth estate or high estate want to consider is taking advantage of those annual exclusion gifts. So an annual exclusion gift is the amount of gift that one person can give to one recipient in a given year without having to worry about federal estate or gift tax issues. And so one person can give $18,000 this year to however many people they want to. So it's not 18,000 total, it's 18,000 per recipient. So the more people you're giving 18,000 to, the more you can reduce your estate in 1 year without any estate or gift tax issues. And then even if you're not really, your estate is still growing, making those gifts can also, slow down the growth of your estate. So hopefully you can reduce your estate tax a little bit in the future. Another thing you can do is make lifetime gifts. So you sometimes might hear us talk about the unified credit. That's the estate and gift tax. You can either give it away during your lifetime, you can give away up to 13.61 million this year, or you can give it away at death. You can't give it away both. So they call the unified credit. So if you use it during your lifetime, you reduce how much you can use at your death. So that's kind of what we're talking about with the unified credit there. So for those of you who can afford to do so, you can give away up to 13.61 million this year without incurring any gift taxes and estate taxes, and you're locking in that high exemption amount. So if you died in 2026 and the exemption dropped to 7 million, you've already given away 13.6 million estate tax free, and so you've locked it in. So those of you who can afford to do so might want to look into the possibility of making very large gifts right now, and I'll show you some ways in further slides on how you can do that without having to give the money to people outright. And then of course, always giving to charity is always going to be estate tax free. They're never going to charge you against your federal estate or gift tax. And you also get that additional benefit of having that, getting that income tax deduction if you do it during your lifetime. So kind of going on again, the gift topic. So one way you can give away that 13.61 million, it doesn't necessarily need to be the 13 million, you can give away, 7, 10, whatever, but in order to lock in the high exemption amount, you can take the exemption and put it into a spousal lifetime trust, which we call a SLAT. We really like our acronyms in the estate planning world, so you're going to see a lot of them in the next few slides. So what you do here is the donor spouse takes his or her own money, puts it in an irrevocable trust for the beneficiary spouse. And so the donor trust gives away the money. He or she has no more direct access to that money. And then the trust terms are what dictate how the beneficiary spouse can access the funds. So, you can pay out all income. So any dividends and interest the trust generates has to be paid out to the surviving spouse. Or terms I see a lot used are health, education, maintenance, and support. So the trustee can make distributions to the beneficiary spouse, basically to allow that spouse to continue living in the manner in which they're accustomed. And then the donor spouse has that indirect access to the funds via the distributions made to the beneficiary spouse. The one thing you need to be very aware of here is if the beneficiary spouse dies, unexpectedly, or if you get a divorce, that donor spouse loses all access to those funds. So you always want to make sure if you're going to make a gift like this that you can afford to not have access to those funds if something happens. The benefits of this kind of trust is once you put it into that trust, you use your exemption amounts. You don't have any exemption, or you've reduced your exemption by how much you put into that trust. But that trust, then all those assets are outside of your estate. And so, if you live another 10 years after funding that trust and it grows $500,000, $1 million, that growth happens outside of your estate and is not subject to estate taxes. You can see you also take advantage of the higher exemption amount You know, if you fund it now with the 13.6 million, you've locked in the exemption. So when it drops to 7 million, you've already given away the 13, almost 14 million without any gift tax issues. The spouse can have immediate access to the assets, again, via the terms that you put into the trust. It's very flexible, how generous you can be to the spouse. And like I said, again, the growth remains outside of the estate. So going on to this next slide is kind of a good picture of how a SLAT might work. So again, you can see that donor spouse is putting money into that irrevocable trust. We do recommend, you know, giving away around, you know, 12, 13 million, just so you can lock in that exemption. And usually that donor spouse is also the one paying the income taxes on that trust. So by the trust not having to pay its own income taxes, you're actually kind of making a gift to the trust by paying its own taxes. So you're allowing more funds within that trust to continue to grow tax-free, or estate tax-free. And then the beneficiary spouse during his or her lifetime receives those distributions from the trust. You know, again, net income, and you can see that health, education, maintenance, and support. That's how most attorneys like to draft it. But if you want to be more restrictive or more generous, sometimes it's going to depend on what kind of trustee you name. But you can put more terms within that trust to allow the beneficiary spouse more or less access than that HEMS provision allows. And then upon that beneficiary spouse's death, remaining trust assets then go to your heirs. So it could be your children, nieces, nephews, family members, whoever. And so all of that passes estate tax-free to those beneficiaries. And then you can keep it in trust for them so they can have the same distribution terms, again, the health, education, maintenance, and support. Or if you don't want them to have to deal with trust, you can also leave the assets to them outright. But basically, you are controlling, when you set up that SLAT, you are naming who those secondary beneficiaries are and ensuring that they're the ones that get the remaining assets of that trust when the beneficiary spouse dies. And then going on to number 3. So this is for people who maybe you don't want to give away so much money irrevocably into this trust. But, you know, what is this trust thing happening in? In that case, you can do a family limited partnership. So then you're putting your assets into this partnership. You can put investments assets basically into this business, and you can remain that general partner. And as a general partner, you maintain full control over those assets. So you can determine how they're invested, when and for what reasons distributions are made to the members of the FLP or the LLC. So you're maintaining control of that. And then you can also control kind of when you're giving ownership units of that FLP to your kids or to your other beneficiaries. And so in doing that, you can also, if set up properly, you can also make sure that those assets get some creditor protection that you wouldn't have if you kept those assets outright. Another big benefit of the FLP is that, particularly if you're one of those people, you have a business asset or real estate, something that is very hard to divide to different owners. If you put that into an FLP, all you need to do is gift FLP shares to your beneficiaries, as opposed to retitling that home into multiple beneficiaries. And so it makes it much easier to gift those illiquid assets that you'd otherwise would have to, you know, divide up into different sections. And then with a big benefit of the family limited partnership is because you're maintaining full control of the assets. You know, the limited partners, yeah, they own it, but they can't do much with it. They don't have any say in the running of that FLP. And if they're going to turn around and try to sell that to a third party, there's no third party person who'd want to buy that for full market value, because that person wouldn't have any control either. So you can actually usually take advantage of discounts when you're giving FLP units to your children or other beneficiaries. So just a very simple example, say you gave $1,000 in units to your child, but because you maintain control of everything, if your child wanted to go and sell that to a third party, they would maybe only be able to sell it for $700. So when you're reporting this gift on your gift tax return, while you're getting $1,000 out of your estate, you only have to report $700 to the IRS as a gift. And so it allows you to leverage your gifts. You can give more money away with less impact against your federal estate and gift taxes. The big drawback with the family limited partnership is you have to make sure that you're managing it as a company. So you can't continue to use those assets as other personal assets. You know, if you put a vacation home in there, you have to start paying rent to that FLP. You can't just continue to use the vacation home. Same with just investment assets. If you need to use the assets, you need to make a distribution from the FLP to your personal account, which might mean making distributions to all the members together. And then you have annual tax filings, annual meetings. So you still have all of those responsibilities of the business ownership in order to get the benefits of the FLP. But like, again, since you maintain full control over it, that kind of helps negate some of those downfalls of having that FLP. Moving on to another way to make discounted gifts is the Qualified Personal Residence Trust, or we call it a QPRT. In this case, it needs to be, like, as it says in the title, a personal residence. So either, you know, your primary residence, or it can be a vacation home. You put that into an irrevocable trust for a specific term of time. So say you put it in the trust for 15 years. You then are able to continue living in that house for those 15 years. And because of the fact that you've maintained that right to live in the house, you get a discount for the gift of giving that house in the trust. So say you put $1 million house in that trust, you get to reduce the gift by about the value of your continued ability to live there for 15 years. So again, you're giving $1 million home away, but you're only having to report, say, $750,000 in a gift. And then say again that home appreciates to 1.5 million within those 15 years. That 1.5 million passes to your heirs, estate tax free, because you've already claimed a gift of 750,000. So you basically doubled your gift over the term of the trust for what you've reported it for. The downfall with this, which probably isn't really a downfall if you're trying to reduce your estate, is at the end of the 15 years, that house now belongs to your beneficiaries, which could belong to them outright, or it could belong to a trust for their benefit. So it's no longer yours. You no longer have the right to live there. So if you want to continue living there, then you have to start paying rent to the beneficiaries of that trust. And so those rent payments then are another way to start getting assets to those beneficiaries. And it's not considered a gift because you're retaining the right to live there with the rent payment. So it's actually income to them. So that can be another big benefit of that QPRT. It's getting that home out of your estate to the people you want to leave it to anyway, while getting more assets to them as well. See, going on to number 5, if I can move ahead, whoops, let me move back. And then another Q trust, the Qualified Domestic Trust. So I mentioned earlier when I was going through the four types of people who might need to pay attention to this Tax Cuts and Jobs Act, the drop of the exemption, is for those with non-U.S. citizen spouses. So green card holders in particular get a lot of the same benefits as citizens. I mean, even when it comes to the estate tax, you still get that 13.61 million exemption, or the 7 million exemption in 2026. You can still give as much money outright to your spouse, an unlimited amount of money to your U.S. citizen spouse without estate tax issues. But unfortunately, the U.S. citizen spouse does not have that same privilege to be able to give an unlimited amount to a non-U.S. citizen spouse without estate tax issues. So the QDOT trust is the way to get around that. So by putting money into that QDOT, so first of all, the U.S. citizen spouse probably want to fund some sort of credit shelter trust with their estate tax exemption amount. But then anything above that, if they did not put it in the QDOT trust, they would have to pay the state taxes on. So the QDOT is a way to get money to that the non-U.S. citizen spouse without immediately having to pay estate taxes on it. And so it needs to have a trustee, an independent trustee who is based in the U.S., and it needs to have certain, the surviving spouse has to have certain privileges to the money, access to the money. The issue there is every time the income payments are estate tax free, but anytime any principal payment is then made to that non-U.S. citizen surviving spouse, that's when the estate taxes has to be paid. So it is a way to delay the estate tax, kind of the same way you would upon, if it was a U.S. citizen spouse, that estate tax probably have to be paid at that spouse's death. In this case, it has to be paid when the spouse actually gets the money. So the idea of this trust is to maintain those assets for the next generation, take advantage of portability between the spouses, and make sure that those assets can potentially be included in the non-citizen spouse's estate at death and using their exemption amount. Oh, now I'm going too fast through the slides. So kind of moving on now to more charitable strategies. There's this charitable remainder trust, which is kind of the same idea as that QPRT, where I was saying it's for a number of years and you get some benefit during the term of the trust before it goes to the remainder beneficiary. The charitable remainder trust is a way to put funds into the trust, get an upfront charitable deduction in the year that trust is funded, and then get income payments from that trust over the term of the trust. So you can have that for a fixed number of years, up to 20 years, or you can actually have the trust last for your lifetimes. If you're to set this up during your lifetime, you usually want to set this up with appreciated assets. So for those of you who have, a highly appreciated concentrated asset, you want to make sure you're liquidating it right away so you can get rid of that concentration without having to pay all the tax up front. A charitable remainder trust is a good way to do that. You put that highly appreciated asset in the trust. The trust is tax exempt, so it can sell the asset tax-free, and you get that charitable deduction up front. However, whenever you get those payments back from the trust over the terms, you get at least annual payments. That is when you're going to pay that capital gains tax. So you're not getting rid of the requirement to pay that capital gains tax in the sale. You're just spreading it out over a number of years, and you're avoiding it somewhat for whatever ends up going to that charity at the end of the trust term. So a charitable remainder trust can be set up a couple of ways. There's the unit trust, which is a percentage of the trust value based on a certain date every year. So if the trust value goes up, your unit trust payments go up. If the trust value drops, your unit trust payments will drop. So it'll fluctuate with the market and the value of the trust assets every year. And then there's a charitable remainder annuity trust where you get the same set payment every year. And as I said before, when those payments are made out to you, that's when you're paying that income tax on that sale of the asset that you did that first year. However, anything that goes to that charity at the end of the trust, since the charity is tax exempt, if there's anything left over, all the capital gains associated with what's left over then passes tax-free to the charity. I'm kind of talking about this as a strategy for during your lifetime, but you can also set this up for a strategy at death. So you can name who those unit trust or annuity trust beneficiaries are. They can be your kids. And so they can they can get an income stream over, say, 20 years and then get charity there. So it kind of allows you to set up an income stream for them instead of giving them, your beneficiaries, a lump sum up front. And the charitable trust is also going to be a very good strategy for IRA assets, because under the Secure Act now, your children probably have to liquidate those IRAs within 10 years and pay tax. If you put it into a charitable remainder unit trust with a 20-year term, now your beneficiaries are paying tax in the IRA over 20 years instead of 10 years. And then you're also giving a charity a benefit because they get whatever's left over at the end of those 20 years. And then again, here's a picture kind of how that charitable remainder trust works. So you transfer the assets into the trust sells them, reinvests them in however you want, and then pays an income stream back to you over the term of the trust or for your lifetime. And then at the end of the term of the trust or upon your death, anything that remains in that trust at that time goes tax-free to the charities. So that's why you get that charitable deduction up front, because there's some expectation that the charity is going to receive something at the end of the trust term. And then if I've kind of overwhelmed you with all those more advanced strategies up to now, something you can do that's a little bit more basic is that credit shelter trust. So this is something you just put in your will or revocable trust, where you leave assets up to the deceased spouse federal exemption amount, or if you live in a state with a state estate tax, the state exemption amount. Kind of the same idea as that SLAT. So you use the exemption amount, and then any growth in that trust between the first and second spouse's death remains outside of the surviving spouse's estate. So this allows you to lock in the exemption amount I mean, this can be very important for if one of you dies, you know, between now and 2026, you can lock in that 13.61 million exemption amount, plus all appreciation associated with it. So I know a lot of people are saying, well, why do I need this? Because I can use portability. The credit shelter trust, again, it gets that appreciation out of your estate. Whereas if you just use portability, that appreciation stays within the surviving spouse's estate. And so what the benefits of this trust, beyond, you know, the appreciation aspect of it, is the surviving or the deceased spouse can control where those assets go when the surviving spouse dies. So the surviving spouse gets access to those assets during his or her lifetime, but the deceased spouse is still saying, okay, upon my surviving spouse's death, I want these assets to go to my kids. And so it protects against, you know, the surviving spouse. If you have a blended family, it makes sure the assets go to your kids and maybe not your spouse's kids. And it also protects those assets against maybe a subsequent marriage from the surviving spouse. And assets in the trust also tend to be protected from creditors. So, you know, if you're the surviving spouse goes out and gets in a bad car accident and gets sued, those credit shelter trust assets are going to be a lot harder to reach than the assets that are in the surviving spouse's individual name. So that's something that even if you aren't going to do anything, you know, from points 1 through 6 that I went through, I would highly recommend that at the very least you do that credit shelter trust. Put those within your estate documents and make sure that irrevocable trust is funded upon that first spouse's death. And now, since the next strategy details insurance, I'm going to pass this on to Joe.
Great job, Kate. So irrevocable life insurance trust, or ILITs, again, we love our acronyms. This is simply put, you're creating an irrevocable trust simply to own life insurance. So the trust is the owner. The trust is also the beneficiary of that life insurance policy. The donor essentially is making gifts into that ILIT each year in order to pay the premiums. If those premiums are over the $18,000 annual exemption per beneficiary of that ILIT, they have to file a gift tax return for each year that they make those contributions. Also, there's what's called a crummy notice that's given to the beneficiaries once those gifts are made each year, because they have the right to actually receive those gifts as a beneficiary of the trust. But we want to use the gifts to pay the premium, not so much to give out a distribution to the beneficiary. So the death benefit is paid to the trust, and therefore the trustee then has the ability to pay distributions to the beneficiaries as per the trust language, right? So that's the idea, is to have instant liquidity upon death that pays into this trust, which is outside of the estate, only to benefit the beneficiaries of that trust. So sometimes people use these in order to create that instant liquidity. Sometimes that liquidity helps in paying the estate tax that may be owed. It could also be used to equalize an estate with beneficiaries. So if you have a business that you own, then you're passing to, say, one of your children, and the other child or children have nothing to do with the family business, but you want to still leave them an inheritance. Sometimes leaving the life insurance in an ILIT like this will help equalize the estate. And it essentially is keeping the life insurance proceeds effectively outside of the estate. So if you own that life insurance individually and you pass away, the death benefit would then become a part of the estate, which we don't want. That's just adding essentially salt into the open wound. So we want to definitely pay or have the life insurance set up inside an ILIT so that it stays outside the estate, and then the benefits of the death benefit will pass to the beneficiaries as per the language of the trust.